up ahead. Affirmative 612.
So, Scott, this week on the podcast, let's talk about listening to economists talk about the economy. Is it a smart way to think about your investing or your strategy? So I actually have an interesting little piece here. We can put a link into it where an economist is talking about a bright outlook for 2026. She feels like it's going to be a good year from that standpoint. But I know you have some thoughts on economists when it comes to that. So let's talk about it. How you doing, my friend?
Great, man. How are you?
Doing pretty good. Looking forward to chat about it. So in general, this particular economist thinks that 2026 is going to be an overall good year. She lists several reasons why. What's your kind of thoughts on pieces like this? Now, it is an opinion piece, to be fair.
Yeah. Well, I mean, I think to me, I like reading stuff from, economists and just to be, I would say more so kind of educated on what's going on in the broader economy.
Sure.
Because I think, you don't want to have your head in the sand about things, but, kind of in the back half of this episode, I do want to talk about, maybe some reasons to not believe economists, but I do want to share, at least in the first part of this episode, some reasons to believe that, hey, 2026 could be a good year. Now, first and foremost, I think it's important that we take a minute to highlight the fact that the market and the economy are two separate things. I think many times people can, combine them into one when they're talking about, how tough the economy is and when the market's down necessarily, or they're talking about how good the economy is when the market's up. And sometimes those two things are very different, right? I mean, even last year, we had, or even year prior, we had some challenging economic news, but the market did really well because of, certain technology sector, AI driven market performances, large companies driving it, where a lot of other companies were not getting those same level of returns. And so that can lead itself towards the market's doing one thing and a handful of companies are driving the returns, but that doesn't necessarily mean that the broader economy is healthy in all sectors.
That's a great point, because I was just looking before we got on here. So in 2025, we think of the Mag 7, right? The S&P 500, it's 500 companies, right? But the Mag 7 dominate the news all the time. And of course, if tech takes a hit, it looks pretty bad. But the other 493 actually did better this in 2025, which I think starts to show improvement and a bit more diversification across the board there, which could be helpful
for sure
in 2026. Yeah,
absolutely. So, I mean, I think, reading this economic piece too, in terms of hey, what are some reasons to believe for 2026?
Okay.
And I think these are still good to look at. I mean, the first and foremost, consumers are going to have more money, right? So when we think about purchasing power is going to drive corporate earnings. Corporate forward-looking projections of corporate earnings drive what the market does.
Yeah.
And so, the market and the economy are connected. They're obviously interrelated, but they're very frequently not correlated. They do have different things going on, and they're two separate things to talk about. So again, on the economic side, larger tax returns,
which the IRS kind of did talk about last week, said that that's probably going to be the case for a lot of people. So,
yeah, I mean, it was significant. I think the number I saw was, it was something like $500 billion. It's a lot. It's a lot of money that's going back that is going to, again, probably get saved, invested, or spent, and more times than not spent. So
spent. I was going to say more times than not spent is the one.
Yeah,
but
if it's spent or invested, both of those will be good for the market. But if it's
but right, it does pump into the general economy if it does get spent, which corporate earnings obviously like that, which translates to jobs, which translates to so yeah.
Exactly.
Yeah.
So, that's one part of it. Very similarly, businesses will have more businesses. Interest rates are down.
And could continue to go down.
Absolutely. So. We're in a decreasing interest rate environment, which is good for lending, good for corporate spending. And so when we look at some of the tax changes in terms of, just depreciation and equipment deductions and things of that nature. So there's a favorable environment, I would say, right now for corporations to invest. Interest rates continuing to come down is another big one, right? So that's going to make people, more likely to sell and buy homes, more likely to, take out debt to get projects done, et cetera. So, I mean, interest rates are going to drive a lot more lot more corporate spending. But again, when we look at the last couple bullet points that she highlights here, energy could be cheaper.
To me, Scott, that's the big dog, right? The tax returns and energy could move the needle more than anything, because if you bring energy costs down across the board, trucking, shipping, internationally, homes, right? Whatever, that could move the needle more than anything else.
I mean, look at a gallon of gas. Gallon of gas is what, 40% cheaper than it was a year and a half ago? It's significant. Yeah. I mean, and that's money in people's pockets for sure.
For sure.
And that's increased purchasing power elsewhere in other sectors of the economy. And I think the last one, she highlights here is more certainty around tariffs. I think that's a good point for sure. Again,
now that said, this week, maybe not so much.
Well, we just got done. And we're going to talk about this in the next episode a little bit, I think, on some of this Greenland stuff, right? And
correct.
The tariff dialogue around that between the EU and we know that is a lever the president is willing to pull. So, and this is a little bit feeding to my next point around what economists can latch onto and write their dissertations on is, more certainty around tariffs until there's uncertainty around tariffs. And so you're bringing up a great point here with the Greenland stuff. Now, we can look and still say that, like, even last year, in the beginning of the year, the economy was, I would say, pretty stable, but we have a new president coming in and he's making all sorts of changes around tariff policy and some of our trade policy. And that instantly caused, a lot of market volatility last year. And so could that happen again? Absolutely. But uncertainty is what tends to make investors uneasy. And so in general, I would say, even knowing that the president can pull the lever and that he's probably going to whenever he's not getting what he wants, now that people know that that's kind of a routine behavior, I think that even drives a certain level of certainty.
It's almost like the government shutdown stuff, where it gets baked in. Like the market didn't care, about the shutdown. And I think they're getting comfortable with it's his negotiating tactic. He may or may not pull that lever, and we're not going to react too much. It's wiggled a little bit since last week when it said all new numbers, but not a ton, right? So we'll see how it does.
Right.
So what's the opposite then? If those are a lot of the pros, and she makes some great points about the economy, what are some different takeaways on the opposite side of things?
So in when we talk about, opposite side, I don't want to say that, hey, these are reasons not to believe that 2026 will be a good year, but
fair.
But more so, to me, like anytime there's economists on TV or in the media or putting information out on social media, I mean, to me, you should put a big asterisk there, right? There's a handful of reasons why I think we should be hesitant around using, I'll even say economic data, but economic data and definitely economic predictions to drive investment policy, investment discipline.
That's a good point, because I mean she's made some great points, and they may actually play out. But a year from now, she could easily do an opposite piece and say, "Well, let me tell you why it didn't work." Right?
1,000%. And this is the part where I feel like the economists, despite their good intentions, can drive a lot of confusion for people. I mean, one of my favorite quotes is how an economist is as famous for predicting 9 out of the last 5 recessions. You know what I mean? And I mean, it's just one of those things that, like, if we keep predicting a recession and then eventually when it happens, I can be like, I told you guys so. I've been saying
there's a great classic case of that. There's a famous one. Guy's last name is Dent, I think. And he kept saying, we're going to have this massive downturn. And I think he started saying it in like 88. Yeah. And when we finally had, like the really big one, in 2001 or whatever, he was like, see?
So, I mean, I don't know.
It only took me 14 years to be right, but exactly. I told you I was right.
Exactly. Yeah. It's like me trying to win an argument with Andrea. So,
okay. Right. So that's a good one. Right.
But, you said only 14 years to be right. That's what made me think of that. But,
sure.
But I mean, ultimately, the economists, they're studying the economy. Right. And so, their best tool is hindsight. So they're looking at lagging data. And the other thing I would tell you is, like, is all data perfect? Absolutely not. So they're looking at lagging, sometimes very incorrect data, but it's the best data that we have, so we still use it. Right. And so I think it's kind of one of those things where, you got to be careful what you're listening to. They can say things that make a lot of sense, and then they can go on to be proven right when the market does a certain thing or the economy does a certain thing, and then they could also be proven wrong all the time. And again, generally speaking, the economy and the market are both doing better way more often than they're not. And so if you're saying, like, hey, here's reasons to believe and here's why things are going to go well, I mean, statistically, 80% of the time, the economy and the market are doing well. So, and I always go back to, I guess one of the key things, like a fundamental economist assumption, is that they're assuming there's a level of rational behavior, right? So like people are not necessarily going out and the economy is just the summation of what everybody is doing out there in the workplace, and the economic activity it's producing. That's a lot different than what goes on in the market sometimes. The market is irrational at times. It overreacts in negative ways. It overreacts in positive ways. And all those things, kind of feed on people's emotions around fear of missing out, fear of loss, greed.
Yeah.
You're hearing things from Jim Cramer on TV, or hearing what your neighbor did, or hearing what somebody in the cockpit did, and how they have all their stuff in silver, and now you need to be in silver or whatever. I mean, there's just all this stuff that drives chaos in the market sometimes, that is completely independent of what unemployment rates are looking at, what monetary policy is doing. I mean, they're completely disconnected. And so there's this assumption of rational behavior in the economy that an economist, I think, would want to translate over into the market, and it just doesn't.
Yeah, that's a great point. And I think they ignore opportunity costs and compounding as well, right? So they love talking about the valuations or the overvaluations of companies, right? But not necessarily things that I think investors are more concerned about.
Yeah, I mean, from an investment standpoint, you should be focused on controlling what you can control, right? Fees, expenses, asset allocation, rebalancing, tax planning, after-tax returns, total return. I mean, just looking for total return. And so, when I get anchored in on what corporate earnings are, I mean, I can get really anchored in what the earning numbers are and the valuations to that. I mean, in my opinion, valuations have just not been a good indicator of what the market's going to do. It's a backwards looking. You can miss out on a decade's worth of growth because the market was overpriced. And then when
especially
the market
recently
corrects, you can sit there and say, oh, see, I told you it was overpriced. That's where it came back down. Well, it always comes back down a little before it continues its eternal march up and to the right.
Yeah, I mean, that's a good point, especially lately, right? Because with all the AI boom, and I get it, right? But it's is it overvalued? And if it is, do I want to be on the winning side or the losing side? Should it crash, right? Should it bubble out?
Yes.
Right. So,
well, and then I think just kind of putting a pin in this one, Mark, the last thing I would say is just a little bit around, I mean, I would call it the weatherman effect. There's not necessarily a lot of accountability, I mean, there's not a lot of accountability for what they say. And it makes me think, I saw Elon Musk telling this joke, so I guess I'll share it, Mark.
Okay.
Since you seem it's a Monday, you're in the mood for a good joke here, I can tell.
Lay it on us.
So there's these two economists, they're walking down the road, and, the one sees a pile of crap on the ground. He says, hey man, I'll give you $100 if you eat that pile of crap. He's like, oh, okay. Oh. He eats it. He gives him the $100. They keep walking. That economist looks and sees a pile of crap on the ground. He tells the other economist, hey, I'll give you $100 if you eat that pile of crap. He eats the pile of crap, gives him the $100. What does the economist say? Hey, we grew the economy by $200. But, at the end of the day, what got done? I mean, it's, you know what I mean? So it's,
they just, what a terrible setup, but yes. But all they did was trespass the money along.
Just
right?
Awful. But I mean, it's a little bit of just there's a certain element of truth in that I think, and hey, they're providing good data for us to, drive government decisions on and things. It's absolutely needed. So
but there's zero accountability. The weatherman effect is correct. I like that. Yeah. They can tell you all sorts of stuff, and that means there's a few jobs out there where you can be wrong 50% of the time and never lose your job.
Absolutely. Yeah. I mean, it's so I don't know. I mean, it's hey, again, we appreciate the data, but it's not something that we should take all that and go in and say, well, hey, some economists are warning that there's an imminent recession. Because I always go back to, Goldman Sachs, man, brightest minds in finance from across the country in one place in 2022, giving us a 100% chance of going into a recession. And we didn't.
Yeah.
And so that to me, there's a lesson to be learned there. And again, back to accountability. I mean, when we didn't go into a recession, everyone's like, oh, did anything happen to Goldman Sachs? No, they're doing just fine.
Yeah. Wow. We're surprised, and we move on. Well, back to the original piece from this Economist. How do you feel about 2026? Do you feel as though we're going to have an optimistic type of year, or a little bit more pessimistic from an economic
if you
standpoint?
talk to all my folks, they're going to tell you too, I'm the eternal optimist. The market is. I agree that stocks look expensive. They did last year too.
Right.
And they did the year before that. And so, if you are getting really pent up about that and not keeping a good long-term perspective, I think you're probably going to see decreased lifetime returns from trying to take economic input and drive investment policy off of it. So,
yeah, we have this would be a fourth year. So we've had basically 18, 20, 23% last 3 years.
Yeah.
Will we see that high? Maybe not. Right. Maybe not. Who knows? But I still think, in my opinion as well, and again, our opinion, but I do think we end up with a positive year. So we'll see. Yeah.
There's a lot of good news out there, but I sent a client newsletter out too. And, I would always remind I don't know if it's going to be this year or the year after. And candidly, our money doesn't care what's going on the calendar. It means the date means nothing in terms of our long-term investment philosophy. But I think there's going to be some sort of, pretty sharp correction sometime from the next big shock. I don't know what the next big shock is. Could it be China invading Taiwan? Could it be tariffs around Greenland? Could it be some other war, some other crisis? I don't know. I do know that is absolutely going to happen sometime. I know I'm sounding like one of the economists, but we don't know when. Like the market and the economy can not be accurately predicted. I just believe that in the deepest part of my bones, and so
the headlines will change,
absolutely.
Right? But every single year, but we have. Well, you said it earlier. Control what we can control, and then hopefully we can roll through those changes as best we can.
And I still think back to 2020. I can't imagine. You remember that unemployment chart that was like this, and then in 1 month, just went as high as it's ever been, and during the pandemic,
putting people back to work. Right?
No, that was
or when they went out of work.
They went out of work. That was the unemployment chart, and. And I remember seeing it when it came out, from our, beloved economists, and just being like, man, that just is tough to see the number of people unemployed. And again, the market finished up 20% that year.
Yeah.
And it has tripled since then. And so to me, I think, and that was after it dropped 33% in a month. And so, yes, there's going to be a big shock sometime that shocks the system. And the market's going to probably overreact. And, if you're a disciplined investor, you're probably licking your chops a little bit like, man, this will be the last time. Those prices we saw in March of 2020, we will probably never see those equity prices again. And so, the next big shock, I don't know what it is. I don't know when it is. It will happen. And hey, let's have a plan and be ready to take advantage of it and use it to our advantage. Absolutely. Yeah.
That's what you do, right? So that's why you reach out and you talk with a qualified professional, the economists and the big talking heads out there, like your Ramseys and your Ormans and so on and so forth. They don't have that accountability factor because they're selling their books, they're selling their different things, whatever. When you're working with an actual financial advisor who's in the trenches, who is governed, right, who has rules and regulations they have to follow, then you have these different pieces in place to get the right strategy for you. So if you need some help, reach out to Scott, click on the links down below and get started with a conversation and a consultation today. And don't forget to subscribe to us on Apple, Spotify, and of course right here on YouTube. And with that, we will see you next time here on the Wealthy Pilots Podcast with Scott Osborn. Thank you, my friend.
Hey everyone, real quick, if you haven't grabbed Scott's Financial Flight Control Toolkit yet, now is the time. This is packed with tons of helpful resources and tools like this, Scott's book, The Dichotomy of Wealth, which is a pilot's guide to maximizing wealth and cash flow in retirement. You also get access to some great guides like this one, Advice Matters, which breaks down 4 key ways a good financial advisor can help you boost your returns over time. And guides like this one on the pitfalls of emotions when it comes to investing, and this one on the HCM byline investment strategy, and more. So if you'd like your very own financial flight control toolkit, just click the link in today's show description, and Scott and the team will be happy to get one sent your way at absolutely no cost to you.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.